Loci. Identify and explain segmentation variables, such as product variety, buyer type, distribution channel, and buyer location. Product variety is a key segmentation variable, referring to differences in product features, quality levels, technological sophistication, or customization options. Firms may segment markets based on premium versus economy offerings, standardized versus customized products, or innovative versus traditional solutions. Each variety often involves distinct cost structures, pricing strategies, and competitive positioning. Recognizing product variety differences enables organizations to tailor production processes and marketing strategies to match specific customer needs and competitive environments. Buyer type differentiates segments based on the nature of customers, such as individual consumers, small businesses, large corporations, or government agencies. Each buyer type has unique purchasing criteria, negotiation power, and service expectations. For example, institutional buyers may emphasize long-term contracts and cost efficiency, while individual consumers may prioritize brand reputation or convenience. Understanding buyer type helps refine value propositions, pricing models, and relationship management strategies. Distribution channel and buyer location further define segmentation. Products may be sold through online platforms, wholesalers, direct sales teams, or retail outlets, each with different cost implications and customer access patterns. Geographic location, domestic, regional, or global markets, affects demand conditions, regulatory environments, logistics costs, and currency exposure. By analyzing distribution and location variables, firms can optimize channel strategies, enhance market penetration, and align operational capabilities with regional competitive dynamics. Csca. Distinguish among domestic, regional, and global businesses and demonstrate understanding of the strategic implications of each. A domestic business operates primarily within one country and competes within national boundaries. Strategic focus is typically on understanding local customer preferences, regulatory requirements, and competitive dynamics. Risks related to currency fluctuations or cross-border political instability are minimal. However, growth opportunities may be limited by domestic market size. Strategy emphasizes local market penetration, operational efficiency, and responsiveness to national economic conditions. Competitive advantage often depends on strong brand positioning and knowledge of domestic cultural and legal environments. Regional business operates across multiple countries within a geographic region, such as Europe or Southeast Asia. Strategic implications include managing moderate cultural differences, regulatory diversity, and cross-border logistics. Firms must balance standardization with limited adaptation to regional preferences. Economies of scale may be achieved through shared operations, while currency and political risks increase compared to domestic firms. Strategic planning requires coordination across markets while leveraging regional trade agreements and supply chain efficiencies. A global business competes across multiple continents and markets worldwide. Strategy must address significant variations in culture, regulation, economic development, and competitive intensity. Firms often pursue global standardization to achieve economies of scale, while selectively adapting to local conditions. Global operations introduce currency risk, geopolitical risk, and complex supply chain management. Competitive advantage may derive from global brand recognition, access to diverse resources, and worldwide distribution networks, but strategic coordination and risk management become substantially more complex. Csca. Define fragmented industry, provide examples, and explain why certain factors lead to fragmentation. A fragmented industry is characterized by a large number of small and medium-sized firms, with no single company holding a dominant market share. Examples include restaurants, hair salons, auto repair shops, and small retail stores. These industries often lack strong economies of scale, meaning large firms do not have substantial cost advantages over smaller competitors. As a result, the market remains dispersed among many participants rather than consolidating into a few dominant players. Fragmentation often occurs due to low economies of scale and local brand loyalty. When production, marketing, or distribution does not significantly reduce costs at higher volumes, there is limited incentive for consolidation. Additionally, customers may prefer local providers due to personalized service, convenience, or community relationships. This local preference makes it difficult for national chains to fully dominate the market, sustaining the presence of numerous independent firms. Low entry barriers also contribute to fragmentation. Industries requiring limited capital investment, minimal regulatory approval, or basic skill sets allow new entrants to easily enter the market. Without significant technological advantages or proprietary assets, firms struggle to differentiate strongly. Strategic implications include intense local competition, price sensitivity, and the need for niche differentiation, customer service excellence, or operational efficiency to maintain profitability within a highly competitive environment. L. Define strategic group and identify strategic groups within an industry. A strategic group consists of firms within the same industry that follow similar strategies or compete along similar dimensions, such as pricing, quality, geographic scope, or distribution channels. While companies operate in the same broad industry, they may differ significantly in business models and competitive approaches. Identifying strategic groups helps managers understand direct competitors more accurately rather than viewing the entire industry as homogeneous. Strategic groups can be identified by analyzing variables such as price positioning, premium versus low cost, product breadth, vertical integration, geographic coverage, and service levels. For example, in the airline industry, low-cost carriers form one strategic group, while full-service international airlines form another. Recognizing these groupings clarifies mobility barriers, competitive rivalry patterns, and profit potential within each cluster. The concept of strategic groups highlights that competition is often most intense within a group rather than across the entire industry. Firms within the same group share similar customer segments and cost structures, leading to closer rivalry. Identifying strategic groups in a scenario requires analyzing similarities in strategic positioning and determining which firms compete most directly with one another, thereby refining competitive analysis and strategic decision-making. L. Explain how the boundaries of an industry can change over time. Industry boundaries are not fixed. They evolve due to technological innovation, regulatory change, and shifting customer preferences. New technologies can blur traditional industry lines, as seen when streaming services transformed the entertainment and broadcasting industries. Firms that fail to recognize changing boundaries risk underestimating competitive threats from substitute products or new entrants emerging from adjacent industries. Globalization and digital transformation also reshape boundaries by expanding geographic markets and reducing entry barriers. Companies that once competed only locally may suddenly face international competitors through online platforms. Strategic planning must account for these shifts by monitoring external trends and reassessing industry definitions to ensure accurate competitive analysis and market positioning. Additionally, convergence among industries can occur when firms diversify or integrate vertically, combining products or services that were once separate. For example, technology companies entering financial services or automotive firms integrating software platforms alter traditional competitive landscapes. Recognizing evolving boundaries allows organizations to adapt strategies proactively, explore new growth opportunities, and defend against emerging cross-industry competition. Industry Life Cycle Analysis. L. Define industry life cycle analysis, including the embryonic, growth, shakeout, maturity, and decline stages. Industry life cycle analysis examines how industries evolve over time and how competitive dynamics, demand patterns, and profitability change across stages. The embryonic development stage is characterized by innovation, limited customer awareness, high uncertainty, and significant research and development investment. Few competitors operate in the market, and demand growth is slow. Firms focus on product development, market education, and establishing technological standards. Entry barriers may be low, but risk is high due to uncertain demand and evolving business models. The growth stage occurs when demand accelerates as customer acceptance increases. Revenues expand rapidly, new entrants join the market, and firms scale production to meet rising demand. Competition intensifies, but profitability can remain strong due to expanding market size. During the shakeout stage, growth slows, excess capacity may emerge, and weaker competitors exit or consolidate. Firms compete more aggressively on price and efficiency, leading to industry consolidation and increased barriers to entry. And the maturity stage, demand stabilizes, growth slows significantly, and competition centers on cost control, differentiation, and incremental innovation. Profit margins may narrow due to intense rivalry. Finally, the decline stage is marked by falling demand, technological substitution, or changing consumer preferences. Firms may pursue niche strategies, harvest cash flows, divest, or exit the industry. Life cycle analysis helps managers anticipate strategic challenges and adjust competitive positioning accordingly.